In July 2026, the Federal Reserve held its benchmark interest rate steady at a range of 3.5 to 3.75%. This marked the fifth consecutive policy meeting where the committee chose to keep rates unchanged. Under normal conditions, a rate pause provides relief to the bond market. The prevailing logic is that once the central bank stops hiking, the pressure on yields should begin to subside. But July 2026 produced a paradox. The Fed funds rate remained flat, while long-duration Treasury yields spiked to two-decade highs. The 10-year yield also climbed to 4.45%, indicating aggressive selling of long-term bonds despite the pause. This move creates a significant burden through opportunity cost. When the government offers a risk-free return of nearly 4.5%, the incentive to hold assets that don't pay interest, like gold or speculative tech stocks, diminishes rapidly. We saw that pressure translate instantly into the paper markets. Bitcoin fell 2.77%, silver dropped 2.15%, and gold prices slid 1.32% as capital migrated toward the higher yields available in treasuries. However, this paper market retreat hides a deeper contradiction. While private investors sold off, global central banks were doing the opposite. They were acquiring physical gold at some of the highest rates on record. The common assumption that a Fed pause is inherently stabilizing is being challenged. The bond market is reacting to a new structural reality that the central bank's current tools may no longer be able to contain. The primary driver of this bond market anxiety is the persistence of inflation. The PCE price index, the gauge the Fed watches most closely, is currently holding at 3.7%, well above the mandated 2% target. Looking at the cumulative effect, consumer prices have risen 20.8% over the last 5 years. This sustained increase has created a level of price stickiness that is now difficult to reverse. The Fed is struggling because the current inflationary pressures are coming from supply-side shocks that don't respond to interest rates. The most prominent is the ongoing instability in global energy. Disruptions in the Strait of Hormuz have kept Brent crude prices near $100 per barrel. These geopolitical constraints keep energy costs high, regardless of how much the Fed restricts the money supply. These energy costs act as a tax on the entire economy, increasing the price of transporting goods, running factories, and delivering basic services to consumers. Beyond energy, a second driver is emerging from a massive multi-year shift in corporate investment: the artificial intelligence infrastructure race. Tech giants are currently in a price-agnostic spending cycle, pouring billions into data centers and hardware. This isn't discretionary spending. It's a structural requirement for their future business models. This build-out creates inelastic demand for specialized labor, raw materials, and massive amounts of electricity, putting constant upward pressure on prices. This reveals the Fed's current dilemma. Rate hikes can reduce consumer spending, but they cannot reopen shipping lanes or slow down a global technological arms race. Because the central bank's tools are ineffective against these specific supply-side bottlenecks, the inflation we are seeing is becoming a structural fixture of the economy. Inside the Federal Reserve, this realization is creating rare and visible friction among the board members tasked with setting policy. While Chairman Kevin Warsh led the decision to pause, the vote was a contentious 9-3. Dissent on this scale is highly unusual for the FOMC. 3 regional presidents, Beth Hammack, Neel Kashkari, and Lori Logan, voted against the pause, arguing that rates should have been increased further. Their concern is that current policy is simply not restrictive enough. They believe that by pausing now, the Fed is failing to exert enough pressure to actually cool the economy. The labor market supports their hawkish view. Unemployment has remained stable at 4.2%, suggesting that despite previous hikes, the economy is still running hot enough to support further price increases. Hammack pointed out that businesses are no longer seeing pricing pressures as temporary or fading. Instead, they are describing these pressures as broadening across their entire supply chains. Kashkari has been even more vocal, stating that the risk of over-tightening is much lower than the risk of allowing inflation to become a permanent, entrenched part of the American economy. When the Fed is this divided, it signals a high degree of uncertainty to the markets. If the policymakers themselves can't agree on the path forward, institutional investors lose their baseline for risk. The resulting spike in bond yields is essentially the market taking over. Because the Fed is paralyzed by internal dissent, investors are repricing the cost of capital themselves to account for the ongoing inflation risk. The friction in the economy is currently most visible in the distorted relationship between short-term and long-term government debt. This 10-2-year Treasury yield spread is currently deeply negative, meaning short-term debt pays more than long-term debt, historically signaling economic distress. This inversion lasted from July 2022 through August 2024, marking one of the longest sustained yield curve distortions in history. Interestingly, while the long-end yields are surging, the odds of a Fed rate hike in September have actually fallen to 67%. This indicates that the bond market is repricing based on long-term structural fears, rather than the Fed's next immediate move. This environment is a direct penalty on speculative markets. When risk-free yields stay high, capital naturally flows away from paper assets and into the safety of government debt. Physical gold demand is rising sharply as central banks diverge from retail investors. In Q2, central banks added 289 tons, a 62% increase. Q1 actual purchases hit 244 tons, driven heavily by China's aggressive net imports of 317 tons, nearly tripling their previous quarter. Even in India, demand is higher than it appears. A 15% import duty has pushed an estimated 100 tons of gold into unofficial off-book channels, masking the true scale of the country's accumulation. These sovereign actors are ignoring the short-term yield parity that retail traders follow. They are methodically swapping their paper reserves for hard assets, prioritizing physical security over interest-bearing debt. When we synthesize these variables, supply-side inflation, internal Fed division, and the bond market's aggressive repricing, a clear picture of economic instability emerges. The inverted yield curve remains the most consistent indicator of where we are headed. Historically, an inversion of this magnitude precedes a recession within 18 to 92 weeks. The pressure in the financial system is reaching a critical threshold. Large institutions are increasingly viewing the current spike in yields not as a temporary fluctuation, but as a one-time shift in the cost of capital. There is now a distinct split in market behavior. Retail speculators are selling off non-yielding assets in a race for yield, while central banks are quietly doing the exact opposite, accumulating physical gold at an unprecedented scale. This mass accumulation of gold by sovereign nations suggests a declining trust in the long-term stability of fiat currency and government debt systems. While the headlines focus on whether the Fed will hike or pause at the next meeting, the data shows that the world's most powerful financial actors are already diversifying away from the paper system and into hard assets.